Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. It can be both an exciting but overwhelming time for many first-time parents when welcoming a child to their growing family. Uncertainty around financial planning can add an element of stress. The tug of war between saving for retirement and college, what types of life insurance are most appropriate, and executing a will or trust can create a myriad of questions for both new and seasoned parents alike. Matthew Spradlin is a certified financial planner with Godfrey and Spradlin Private Wealth of Steward Partners, and he and his team have created a new parents pyramid to help guide families and provide insight into these topics and more. We're going to focus on those three key areas. Matthew, this is a fantastic topic. Thank you for bringing it to our attention, and welcome back to Trade Talks.
Great to be with you again, Jill.
Let's start with estate planning. The foundation of your pyramid focuses on estate planning. How do you recommend parents get started with this topic?
Yeah, the first thing new parents really should do is sit down and have an open and honest dialogue with one another about what's important to each of them when it comes to raising of their new family. Should events unfold where neither of them would be capable or around to raise their child? Important topics such as values, living situation, including geography, loved ones that would care for their child and who they feel confident to oversee their finances. And this conversation is the foundation when it comes to making specific decisions around your estate plan, and quite frankly, should really take place before you even begin to think about hiring an attorney to execute documents.
Which documents are most critical when it comes to estate foundation?
Yeah, a basic will is an absolute must. A will is a bare minimum tool that will ensure your wishes are not left to someone else to determine. So like naming beneficiaries on a retirement account or transfer and death instructions for taxable accounts, it's an important document to name intended recipients of your assets. Another must-do is naming a guardian for your minor children. Do not leave this most important decision to the court system. And look, be sure that you share this information with the guardian you've selected. Do not let it be a surprise to them. Also, I recommend a trust for parents with minor children. A trust can seem like a complex vehicle, but in reality, it's simply a document that spells out how you want your liquid assets, your home, insurance proceeds, etc., to be distributed to your loved ones. So as an example, it can depict specific timeframes, uses for the assets, and even some age restrictions.
Yeah, I think when people think of trust, they think of, massive family dynasties and having all of their wealth into trust, but it really runs the gamut. So what are some specific recommendations when it comes to successfully implementing a trust?
Jill, I think you hit it on the head. And I begin by saying, try not to overcomplicate it. You're going to name a successor trustee, and that's just the person you leave in charge to ensure that your instructions are followed properly and accurately. And this is an incredible responsibility. So make sure you select someone that you feel can handle the oversight of, not only the investments, but distributing your money to your children, dealing with the taxes, and, sometimes having to enforce the limits that you set forth. Beyond distributions for regular living costs for your child, I typically recommend including some language around expenses for things like education, a first home, a reasonable vehicle, even a wedding. But as far as significant principal distributions, I absolutely recommend waiting until, say, age 30 before making a large portion of the trust available for general use. Specifically, I suggest 1/3 of trust principal being made available at age 30, 1/3 at 35, and then the remainder at 40.
Shifting to the next level of your planning pyramid, insurance can play a significant role to ensure a family's financial livelihood in the absence of the central income source, or in the case of the loss of both parents. What do you recommend when it comes to insurance planning?
Well, much like estate planning, determining which type of insurance and how much you need can feel just as daunting. Insurance comes in all sorts of shapes and sizes. I'm of the opinion that if you're a new parent and your finances are already carrying significant demands, purchasing expensive permanent insurance, such as whole life, really should be low on that priority list. Term policies are going to offer the best bang for your insurance buck. And the combination of youth and good health should really allow for a significantly larger death benefit with significantly lower cost or premiums relative to, say, permanent policies.
How much insurance do you typically recommend for new families?
There's certainly no one size fits all when it comes to how much insurance coverage a family requires. So I usually begin with, say, the low hanging fruit. Start with your employer's benefits programs. Most companies are going to offer you the opportunity to participate in a group program that provides, say, some sort of salary multiple And because it's offered through an employer, you have the benefit of the group, meaning the likelihood of lower costs versus, say, obtaining an individual private policy. It's also only going to typically require what we call a statement of health at most. Once you have that in place, that's going to serve as a really nice foundation. Then you can build from there. So we talk about both current and future expenses when it comes to, say, insurance planning. So you want to think about the obvious items that would need to be covered in the near term, such as mortgages, vehicles, outstanding student loan debt. But longer term items, such as, say, ongoing cash flow needs for daily life, future college costs, or even unforeseen medical bills, you've got to consider those as well. All those are factors that should go into determining how much coverage a family really should obtain.
The final component of your pyramid focuses on smart savings, which you consider a hierarchy of where savings dollars are best utilized. Can you expand on that?
Absolutely. One of the first things new parents are typically eager to do is begin saving for college. And year after year, we all read about and see this parabolic rise in higher education expenses. College savings, like life insurance, you should really be considering that carefully as well. So we usually recommend younger investors, they want to make sure that their long-term retirement plans are in good order prior to moving on to, say, college savings. And that's not to say that you can't save both simultaneously, but we see parents too often sacrifice their own retirement goals to try to alleviate as much of that burden for their child as possible. And look, as a parent, I completely understand, but we remind folks that you can always borrow for college, but you really can't borrow for retirement. So once we feel long-term savings plans are in good order, then we're comfortable recommending saving strategies for college.
That's a great point that you make there. Which types of college savings plans do you recommend then?
529 plans are the gold standard, when it comes to college savings. And as a reminder, these accounts are designed to receive after-tax dollars, and they're invested for future tax-free growth, much like a Roth IRA, for example. The distribution, so long as they're considered for higher education costs, are completely free of taxation. Additionally, the flexibility they provide is tremendous. They can be used for, say, public or private schools, in-state or out-of-state tuition. You can even change the beneficiaries of the account should your child no longer need the funding, say if they were to receive a scholarship, for example. Also, you can select a 529 program offered by any state you like, meaning if you prefer the investment provider or options offered by a state in which you're not a resident, you can select that one for your child. But just be careful on that one. Some states do offer annual tax breaks for contributions made by its residents who participate in their specific plan.
And finally, Matthew, when it comes to additional long-term savings vehicles for young parents, which do you recommend?
Oh, look, the way the market's performed the last few years, we're asked all the time about investing in stocks or other more aggressive strategies from our younger clients or those that maybe have some additional financial resources. But my advice, you got to begin by taking full advantage of your employer retirement program, such as, say, a 401k. This is going to give you the highest level of tax advantage savings. Also, most employer-sponsored plans now, they're offering a Roth option. And the benefit there is that eliminates the income phase-out barrier that a Roth IRA presents. So only after someone's really maxed out and taken advantage of those employer-sponsored plans and even other retirement options like Roth IRAs, do we then have them to begin to consider, say, after-tax solutions such as traditional brokers for long-term investment dollars.
All right, Matthew, great insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.